Supply and demand continues to disappear, and home builders are starting to take note of this as they're struggling to sell their new builds. They recognize that we're currently in the midst of a housing correction. Now, this is all going according to plan as far as the Federal Reserve is concerned. Their main goal and objective is to take down inflation to those 2% levels, even if it's at the cost of an economic recession. So we got a lot of things to talk about in today's video, between Jerome Powell giving his last speech before the big September meetings taking place. We got home builders that are completely leaving buyers behind, and all the latest information on what's going on in the housing market. But before I get started, do me a favor and support the channel by smashing that like button. And if you haven't already done so, definitely subscribe and hit that notification bell to watch more content like this. And with that said, let's jump into it. Home builders are feeling the shift taking place in the housing market. We're seeing demand completely disappear, and we've seen evidence of that with the Mortgage Bankers Association giving the latest data of mortgage applications, and we're seeing that purchase applications are currently down 1% week on week, which has been a consistent trend we've been seeing recently, and over 23% decline year on year. We're starting to see homes sit on the market longer. Earlier on in the year, we were seeing about 16 and a half days on market nationwide. Now we're up to about 27 days on market, and as a result, we're seeing homes sold go down as well, according to Redfin, down 17% year on year. Now, this drop in demand is significantly affecting home builders, and so because of that, they're having to up the ante with their incentives and price cuts in order to attract more buyers. Now, so far, they've been able to do these price cuts and incentives without losing their shirts, because according to John Burns Real Estate Consulting, we're seeing that home builder gross margins are at the highest levels they've been at in many years. Now, builders also have the responsibility to look ahead at what might happen in the future with the economy and the housing market, and right now the sentiment is that they believe the housing market is not in a very good place right now. In fact, chief economist of the National Association of Home Builders, Robert Dietz, said that the current climate of the housing market is that of a recession, and we're seeing evidence of that amongst home builders, with home builder sentiment reaching the lowest levels since May of 2020, when we were at the height of the pandemic. So builders are starting to change their strategy as they start to see more buyers leaving the housing market. They're starting to shift their focus over to renters. Chief economist Ali Wolf said that there's a lot of builders that believe that the for rent space could offer a great hedge against a slowing housing market. Now, we've talked about this build for rent concept on the channel months ago, and how more and more builders are starting to jump on this idea. Well, the build for rent concept, for those who don't know what that is when you have home builders, they build out their community like they normally do, and rather than selling each individual house to a new owner, they sell the entire community to an institutional investor who then ends up renting out the houses. Institutional investors are attracted to the idea because single-family rents have been soaring recently, and then at the same time, home builders are incentivized because they can sell all their houses at once rather than having to do each individual house, which could take much longer. So right now, there's still a large appetite for these investors to buy these build for rent communities because rents seem that they still have room to grow more. So as we see these home builders shift over to the for rent space, that's going to cause less housing supply to hit the market, which in turn hurts housing affordability, especially if mortgage rates continue to go up. Now, that's exactly what it looks like is already taking place. We're seeing mortgage rates having already gone up from early August at around 5.05% all the way up to recently as high as 6.25%. And it seems like it's a trend that's going to continue going higher. We did see a big surge early on, but we've seen another surge taking place since the Jackson Hole, Wyoming speech, when Jerome Powell gave his speech for the Federal Reserve talking about a continued aggressive stance on monetary policy. So we've seen around a 1% increase in just the last month alone. And so because of that, we're really at the highest levels, other than one day in June, we're at the highest levels of mortgage rates since 2008. Now, this is really hurting housing affordability, because if you had a $400,000 mortgage at 5.05%, you'd be looking at a $2,160 a month mortgage payment, whereas now at 6.25%, that looks more like $2,463 a month, which is a $303 a month increase. So this is exactly why you're seeing so many buyers exiting the housing market, is this housing affordability is just getting worse and worse. And unfortunately, based on what the Federal Reserve Reserve plans to do, this is exactly why I expect mortgage rates to continue rising throughout the rest of this year. You see, Jerome Powell, who's the chair of the Federal Reserve, gave another speech in September 8th, basically reiterating everything he said in his Jackson Hole, Wyoming speech, which was all about how he's going to be committed to fighting inflation. He's made it clear that their goal is to stay aggressive with their monetary policy until inflation levels reach 2%, which honestly, it could be a couple of years until we reach those levels. And so an economic recession is looking more and more like an absolute guarantee at this point. Now, as part of being aggressive, the Fed plans to continue hiking interest rates, which we've been seeing over the past several months. The next meeting they're having is on September 20th through the 21st, and the expectations for that meeting is that they will probably hike rates another 0.75%. So that essentially means if you're looking at a car loan, personal loan, HELOCs, credit cards, all of those are going to go up an additional 0.75%. Now that might not sound like a lot, but you do have to take into consideration that so far this year, they've already hiked interest rates a total of 2.25%. So an extra 0.75% puts it up to 3% total in hiking interest rates. So that means if you could have gotten a 4% interest rate on a car loan back in January, now you would be looking at a 7% car loan. Now it is possible they maybe go a little less aggressive, go with the 0.5% rate hike, but we'll just have to wait and see what they end up doing with that. And either way, the expectations are that they're going to continue hiking rates in November and December meetings that are also coming up. Now, all of this is an effort to slow down the economy in order to bring inflation down. And in addition to hiking interest rates, they also plan to continue doubling the speed now of offloading their balance sheet, which they plan to do starting this month of September. Now, their balance sheet is currently loaded with mortgage-backed securities and treasury bonds, trillions of dollars worth, and we care about that because the supply and demand dynamics of these treasury bonds and mortgage-backed securities directly affect interest rates for mortgages. So their previous goal was to offload about $47.5 billion a month. Now, as of September, their goal is to offload $95 billion a month of treasury bonds and mortgage-backed securities. So if all that goes according to plan, we should anticipate the mortgage rates will continue to go up over the coming months, which could mean a bigger housing correction taking place. Now, even at this point, we're still continuing to see price drops take place at a very high level. Currently, the weekly levels show a 7.3%. You multiply that by 4, and so you have 29.2% of all listings nationwide are seeing a price drop of some kind. We're also seeing that the median sales price is currently down about 6% nationwide, but recently it has looked like it's been stagnating a little bit. So why is that and what's going on? Well, for one, just like we're seeing buying demand falling, we're also seeing new listings falling as they're currently down over 16% year over year. Now, this is the biggest year-on-year decrease that we've seen since May of 2020 at the height of the pandemic. Now, this is making for a slower process of building up inventory because we're seeing these home sellers wanting to wait for a better housing market to sell their house. In fact, some of these home sellers are almost copying the home builders in a way, wanting to rent their home out right now instead of sell. Now, all of this almost creates a stagnating effect as you have on one hand, you have less listings hitting the market as home sellers want to wait for a better market, and on the other hand, you have demand falling off a cliff as more home buyers are getting priced out of the housing market. Now, the second thing to consider is that these Redfin reports, they look at 4-week averages, and the 6% mortgage rates that we've recently seen come into effect have really only happened for the last few days of their entire designated period. Now, I don't personally believe that we'll truly see the effects on this data from Redfin until at least 3 weeks out, because I'm looking at housing inventory, I'm looking at median days on market, I'm looking at median sales price. I mean, if you think about it, even to sell a house, it takes 30 to 45 days from start to finish. So if rates continue to stay high and potentially even get higher than where they're at right now, we're going to have to wait at least a few weeks to really see how it's affecting the data as far as home prices declining is concerned. And at that point, we can start to have a better idea if demand is falling faster than new listings. So overall, this is the latest of what's going on in the housing market. Now, although it does look like the housing market correction is slowing down a bit at this point, personally, I don't believe we've reached the bottom. I still think we have a longer way to go before we get to that point. Mainly, I feel that way because the Federal Reserve plans to stay aggressive. That likely leads to higher mortgage rates, which leads to worse housing affordability, affordability, throw in an economic recession somewhere around there, and now you're looking at more and more buyers exiting the market, inventory piling up, and eventually house prices declining. So those are my thoughts. Definitely let me know your thoughts in the comments below, and if you enjoyed today's video and you gained some value from it, do me a favor and smash that like button, and if you haven't already done so, definitely subscribe and hit that notification bell to watch more content like this. Finally, follow me on Instagram and TikTok at The Out of State Investor, and if you enjoyed today's video, I'm going to highly recommend you watch one of these two videos right over here. And with that said, I'll see you on the next one.